Hi, and welcome to Macro Monday, where we talk macro, trying to make sense of markets that, come on, do they really actually make sense? Nah. And answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today, because I have a great show lined up for you today. And I want to get right into the macro data, but before we do that, I'm going to forewarn you, I've got the dollar on my brain. I saw a piece this weekend. I know you're like, Steve, I thought all you thought about was bonds. I do. I promise. There's a lot of bonds in there, okay? Don't worry. We'll get to that. But I saw a piece of research this weekend talking about how quantitative easing was dollar bearish. It drove me crazy. I couldn't even finish looking at it. And then I saw a piece today on Twitter, someone commenting about how government debt is potentially dollar bullish, and that irritated me as well. So I'm going to show you some charts and why I think they're wrong. But before we do that, let's get into the macro data and see what we can learn this week. We had consumer prices coming out of Hong Kong, went from 1.9 to 1.5 as a sign of disinflation. Let's move into the U.S. data. First up, we have the Chicago Fed National Activity Index going from almost minus 18 to 2.61, the highest level in history in May. What is going on in the national economy? Well, there's a simple way to look, is to actually pull the report. So this is the Chicago Fed National Activity Index. It said index suggests economic growth increased substantially in May, led by improvements in production and employment-related indicators. That is pretty cool. So you would look at this report and think, wow, the economy came roaring back. Let's look at this and kind of dig in to see what it actually says. It says, so what is the National Activity Index? It is an index of The index is a weighted average of 85 indicators of growth in the national economic activity drawn from 4 broad categories of data: production and income, employment, unemployment and hours, personal consumption and housing, sales orders, and inventories. Now, mind you, this is the highest print in the history of this index, which again would suggest that the economy is roaring back. But we know that's not the case. In fact, the Fed knows that too. So how do you read this report? Well, they tell you what do the numbers mean. A zero value for the monthly index has been associated with the national economy expanding at its historical trend. So if you see a zero, it's an average rate of growth. Negative values with below average growth, and positive values with above average growth. So what we would think right now is at plus 2.61, we have above average growth. However, they also recognize, they being the Fed, that this index is a bit volatile and can give some false positives, potentially like we're seeing this month. So if you look in, it says periods of economic expansion have been historically associated values with the MA3 or 3-month moving average above minus 0.70. So they provide that. And it comes in at minus 6.65, and they do that to kind of filter out those big, months plus or minus. So it tells you that perhaps this month is just a one-off print and that the actual trend is still in below average. That's the way you read it, below average. It also has a diffusion index, which they publish down here, and it says that an expansion is associated with a diffusion index above minus 0.35 or at minus 0.43. So the headline number looks good. If this trend can continue, this would be great. Its odds are it's not going to print this high again, because you can see looking back in February, January, December, May, it doesn't make big moves. Of course, it doesn't normally make big moves down or big moves up. But based on the 3-month moving average and the diffusion index, it says we're not quite out of the woods just yet. So let's go back to the browser. So that's kind of how you look at these reports. So if you're not sure, what you can simply do is click, if you're on investing.com, you can click, where did it go? Somewhere in here. Somewhere. Oh, look for the flag there. You can click on this on the report, And this says, where did it come from? You can click on the Federal Reserve Bank of Chicago link, and then you can go find it on their website and look it up. Let's move on to existing home sales. In May, they trended lower at minus 9.7%, and we're down on a year-over-year basis is around minus 26%. Keep in mind, this is going to pop next month. Just forewarning you, it's just the way the report is done. It appears to be lagged, and it's going to jump next in June. Consumer confidence preliminary in the Eurozone showing at negative 14.7 from minus 18.8, so slight improvement in consumer confidence coming out of the Eurozone. And before we will be done with this video, we will have the producer price index from South Korea. So what's cool is we're going to look at that live. I'm not going to cheat because I don't edit. All right, let's take a look at how hedge funds are managed in the futures market. I shouldn't say managed, how positioned in the futures market. And this is where they do their hedging. And as far as the 10-year Treasury, they're pretty much neutral. Not long, not short. They're pretty much neutral on the 10-year Treasury yield. How about the 30-year long bond? Still very short. Now you might say, well, they're not as short as they were. Don't worry. This is still a fairly substantial short position. So what you can see is hedge funds are, they perhaps could be long bonds, but we know they've been selling them based on the TIC report that comes out every month. So we know they've been selling and they are short. So they're betting on higher interest rates, and this would confirm their position there. Of course, they're going to be wrong, but that's what they're betting on. Looking at West Texas Intermediate, see a small pullback on long positions. The market is very long oil in a period where there is a massive amount of oil and products on the market. I wish these people well. I do not share their optimism. We'll just say that. We do know hedge funds are long what's called the cash market, CASH. It does not mean they are long money market funds. It means they are long stocks in what's called the cash market, is what most people trade during when the market is open. So they are hedged on those positions properly by being very, very short the S&P 500. So they're just protecting their downside risk because they have a substantially long position in stocks. Let's take a look at gold. We see not a small increase in gold. The market is just really betting on gold breaking out. Goldman Sachs even published a report that says real yields are going negative. You want to take? I'll take the opposite end of that bet. I think Goldman Sachs is wrong. I think real yields are headed higher, which means I believe that consumer prices are going down much faster than interest rates will. How about on the NASDAQ? Hedge funds went long the NASDAQ. I don't know if I have not seen anything to suggest they're selling tech stocks, but they are both. But I do know they are long tech stocks, and now we see them even longer in the futures market. How about the small caps? Russell 2000. We've seen virtually no change on small caps at all. And the U.S. dollar, hedge funds are short the U.S. dollar, and sometimes when speculators are short the dollar, that's when it has its biggest rally. I still think we're going to see a massive move higher in the dollar. It's going to be a massive wrecking ball. On top of that, I will show you because, again, I was kind of irritated by what I saw over the weekend and today. How about volatility? The VIX, speculators are short vol. Would make sense if they're long stocks. They should be short volatility. And normally you don't see a big move in vol unless speculators are very, very, very short. So that's kind of interesting, but maybe the market's peaked out. We'll take a look at that at some point. So let's go right into the dollar. So like I said, I was really irritated about this. QE is dollar bearish. It's not. It's super dollar bullish. And we've talked about this before, but I wanted to just go over it again. And there's a simple way to do this. You can chart the dollar index against the monetary base. Because what does the Fed have control of when they do QE? Monetary base. So when the Fed is pumping QE, bullish for the monetary base. Odd thing to be bullish about, but it's bullish for the monetary base. All right. So here you can see this is a dollar in blue. This is, and then below in red is the monetary base. So when there was a massive pumping of the monetary base from QE during the great financial crisis, it drove the dollar higher. And it does it. The dollar was front running the Fed's move. And then we can barely see where QE2 is. There was a little pump of the dollar, and then it broke down, and then the dollar finally played catch up to QE3, or QE2. And then QE3 was kind of a low, long grinding elevator or escalator, and it drove the dollar higher. Then look right here. We'll zoom in a little bit. You can see, boom, monetary base goes up, dollar goes up. So the question for where this is going is the next time the Fed goes brrr, now this thing is dollar is boom, going higher. It's going higher, a lot higher. And we do know the Fed is going to have to do some more QE at some point. They're not out of the woods of this deal by far. And if we thought what they did was ridiculous the last time, wait till you see what they're going to have to do the next time to save the markets, because they're going to have to do more. They always have to do more. And what would the indicator be to think that the Fed is going to go brrr again? Can you guess? I will get my arrows out. It's only 1 of 4. You got 25% chance. Yes, if you pick stocks going down, you win. And I know the Fed claims they're not worried about asset prices, but they are. We're going to talk more about where I think stocks are headed, because somebody, again, we don't name names when people send questions, and we do that obviously because for my licenses, but also for your privacy. And someone asked me about a different technical scenario for the S&P 500, and I promised them I would put the chart up. Let's continue this dollar thesis. So then today I see on Twitter someone was commenting about, man, look at all the debt issuance this week. I wonder if that should be bearish for the dollar. No. Look, government debt, here you can see in red, the dollar in blue. The more government debt goes up, the dollar goes up. Now this chart is only good back to 2006, because that's as far back as the Fed has this dollar data. But no, a rising government debt is bullish for the dollar. Now, why would that be? See, there's something called marginal productivity of debt. If I got that right. No, that's not. Let me go. I need to go look that up again. Hold on. Make sure marginal revenue product of debt. There it is. Marginal revenue product of debt. So thanks, Google, for that. So what does that mean? Well, it means for every $1 the government borrows, can you guess how much growth we get? How much of a dollar of growth we get? Take a guess. 40 cents. I know you're like, what? Yeah. Can you imagine if I was in a business where you brought me $1 and I gave you 40 cents worth of goods? Man, that would be great for me. But that is what's going on right now. So how is it that government debt can be dollar bullish? Well, let's break it down and think about it. So the government borrows money from the public, those who have dollars, both in the United States and outside of the United States. So from the international pool, international being domestic and foreign, of dollar holders. So they borrow money. Now the government machine is extremely inefficient. So imagine the most inefficient thing in the world and multiply it by 10 or 100 and you have a federal government such as ours. It's just extremely inefficient. And so when it takes that money that it borrows and it pushes it back out into the economy, it gets 40 cents on the dollar for growth, which is terrible. Because there's some questions and we're not going to go through them today, is what is the Fed's going to do with this $1.5 trillion in the Treasury general account? Think of it this way. It's only good for about $600,000 worth of economic growth, or $600 billion worth of economic growth. That's pretty poor return on your money. I mean, if I told you, hey, I had an investment, you put $1 and you'll guarantee to get 40 cents back, you'd be like, you're an idiot. I mean, nobody would do that, but our federal government does. And we allow it because we don't want to force a balanced budget or a surplus. So anyways, the government is pulling money out of the pool, the international pool of dollars, running it through its inefficiencies and spending it back out. So what's happening is the more government debt we take on, the fewer dollars there are because of the inefficiencies of the system. Because we're taking dollars from those who could create growth, or we're, what I like to use the term of wealth producers. Because, so look, someone's got to fund the government, so the people that have money got to do it. because guess where their wealth is tied to? The fact that the government exists. So they're pulling money from the wealth producers who could take those dollars and potentially create businesses and wealth and employment and whatnot, and run it through their inefficient program and boom, spend it out for 40 cents on the dollar. That is tightening. So that's why government debt generally causes the dollar to go higher. And if we've heard President Trump over almost the last 4 years talk about he wants a weaker dollar. Well, Mr. Trump, I'll give you one hint. Spend less money. In fact, you want to get a weaker dollar? Start running a surplus. That would help you a lot. I know it's not going to happen given what just happened with the coronavirus and the economy being shut down. But that is the trick, is you got to pay back down some of that debt. So what does that mean? Well, if the dollar is going to go bullishly higher, which I believe it will, what is that going to mean for stocks? I'll help you out. It goes down. And what do you think it means for Treasury yields? This should be an easy one if you watch the show. If you guess Treasury yields are going down, and you're on a roll today. Okay, now let's talk about stocks, because someone did send in a question about would you comment about the broadening megaphone pattern? What's a broadening megaphone pattern? Think of it, visualize a megaphone. If you've ever been to a sporting game, usually cheerleaders have a megaphone. Well, visualize that and you've got a megaphone pattern. Now let's go and pull that up. So if you didn't know, you could just go to Google Images and search, or your favorite search engine, search broadening megaphone pattern, and voila, there they are, all kinds of them. And it could be that my search query seems to know what I want without having to put in some other words, but I pulled one of these up and blew it up. And so here's a broadening megaphone. Bullish means it bounces in between the megaphone, see small end, large end. And if it breaks out on the top end, it comes back to reconfirm and takes off. And if it doesn't break out on the top, it goes down, potentially breaks below the megaphone, and then goes off the cliff. So where are we? Well, that's a good question. And for that, we need the trading software. Now, there have been some questions in the comments. Just so you know, I do not take questions out of the comments, but I've seen some people kind of wondering where I get this software program from. It's a great question. It is only available to TD Ameritrade institutional advisors. I don't know if they have something similar for retail customers or not. I just know what they have available for institutionals. So here's the megaphone pattern. Now, it's not perfect, and no pattern is ever perfect, but you can see here's the first leg up, second leg down. It broke out. It looked like it was going to confirm the top and possibly take off. It didn't. Came all the way down to the next stage of the megaphone and looked like it was going to break out again. And as we zoom in, it is sitting just under the top of the megaphone. Now, what does that suggest? Well, if this sells down and it breaks through the bottom of the megaphone, well, guess where that's going to head? Now, we're looking at the largest ETF, SPY. So we can see the bottom of the megaphone currently right now is back where it was in 2015. So let's go to the S&P 500 chart where I've got some lines, and that would indicate the S&P 500 is heading to 2100. But remember, it usually breaks below the megaphone, suggesting we could even see, say, 1900, maybe even less. But that's what this pattern means. It is a consolidation pattern, either to the upside or the downside. So what you're seeing, if I can see it, is buyers coming in, and the bullish pattern is soaking up all the inventory and then shooting it higher. Or in a bearish pattern, what you're seeing is sellers at the top unloading into retail. So retail is buying the dips. Does this sound somewhat familiar? And the pros are selling the tops, the rips. And once the retail has got all in and the big players have sold, well, there's no one left to hold the bag and the bottom falls out. So that is kind of how you take a look at that. Hopefully that helps. So let's go back and look at some charts and see what's going on before the South Korean data comes out, which is pretty soon. So let's go to, I know, we gotta look at the dollar index, dollar DXY. Very technical move, came up, hit the bottom end of the supply zone, which is resistance, and sold off. So remember I said, I think on Friday or Wednesday, that look, this could act as a level of resistance. It did. Now the question is, will the dollar come all the way back down to the top of this other supply zone below it and confirm support, or will it firm up here and then move back into the supply zone ahead? We'll see. There's no way to know right now. But we do know that if the dollar rips higher, well, we can look and do an overlay of what's going to happen to emerging markets. And there's a reason why I'm not overly bullish on gold. I think real yields go higher. The markets think they go lower. But you can see when the dollar rips higher, emerging markets go lower. And so if we get a big move up in the dollar, a breakout of, say, over 103, it's just going to rip emerging markets to shreds. I mean, they're going to be dirt cheap. And usually the same thing happens with gold. So right now we're seeing gold somewhat supported by a weaker dollar. But if that rips higher, let's zoom out a little bit, you can see that a bullish move in the dollar is weak, is a bearish move for gold. So I'm still not sold on this move in gold going to the moon. If it does, from a macro perspective, you always have to have a backup plan in macro, and macro often gives you backup plans. So if I was bullish on gold from an inflation standpoint, when after real yields go up, so real yields go up and then they're going to come back down, and if I was looking at gold and it perhaps enters a bull market before I think, what's my backup plan? I got emerging markets. So that's pretty cool. You always have to have kind of backup plans. Let's take a look at the long bond TLT, inverse of 30-year Treasury yields. Very interesting day from a technical perspective. We saw, let's zoom out to the 10-year or 10-day. It crossed in over this dashed purple line, which was acting as support last week, and then it confirmed that level overnight. It rallied up to the place where I'd like to see it break out into the supply zone above, ran into some sellers, reconfirmed. Now let's zoom in today, reconfirmed support once, twice, 3 times, and apparently, at least in the initial bit of after hours trading, it is reconfirming again. So the longer it holds that support, the better, because when we zoom out, I'll use a 6-month chart, you can see this little channel between the solid purple line and the dashed purple line was acting like as support here, and then or resistance here, and then now it's trying to act as support. If it can hold this, it does set up that kind of bullish narrative. Plus, we have a massive amount of pension funds selling expected to start tomorrow going into month end, because a lot of these asset allocated models, say your traditional 60-40 model, is overweight stocks right now, and most of them reallocate or rebalance at the end of the quarter. Well, that means there's going to be a lot of equity selling potentially and a lot of bond buying. Remember, the big commercial banks bought a boatload of bonds. It was like 80 or 90 billion over the last couple of weeks. Look, they're putting their cash into the bond market. They know what's going on by far more than anyone else. All right, let's jump into some of your questions, and then we'll pick up that South Korean data as it goes live here. Okay, now this question came last week, and I'm going to get something set up for that. I'm not going to read this whole part because the person who submitted the question we had a short dialogue back and forth, because I had opinion change on this. And I guess I should tell you the opinion change was, I said the original question was, can the primary dealers buy U.S. Treasuries at auction on margin or debt? Can they borrow the money and go to the auction? And something in my brain remembered that we did allow that to some degree, and so it kind of roughly made sense. And then the person wrote and said, after I answered, and said, hey, wouldn't that then be inflationary? And they're like, wait, you're right, that would be inflationary. So no, they can't buy Treasury securities on margin, because it's not allowed. I mean, if we really wanted to create inflation, then the federal government would borrow from the banks. That would be the way to do it. So let's read the first part of your question, then I'm going to tell you kind of what my thoughts were on this. This person did have some follow-up questions, so we'll get to, and I'll allow them to resubmit whatever pieces if they want. So I previously asked you about whether or not the securities dealers were able to purchase U.S. Treasuries from the Treasury auction on credit. Thanks for the brilliant answer to my previous question. However, this has also left me with more questions. Now, like I said, we did have a brief dialogue back and forth, and then it occurred to me that there was something the Fed did, and I just needed to remember what it was, and it's called, this is brilliant, you're going to love it, the primary dealer credit facility. Now, right now, there's $5.6 billion of loans out to primary dealer credit facilities. So what is going on here is simple. The Fed knows when they issue, or periods where they have to issue a lot of debt, the system can get bogged up. So it's like taking a whole bunch of stuff, sticking it in your sink, turning the water on, the garbage disposal, and just jamming the stuff down. And just like, yeah, let's see if you could chew up all this stuff. Well, sometimes it can't, and it gets bogged down, and then next you know, everything's coming back up. And the Fed doesn't want that. So effectively, they had the primary dealer credit facility available during the great financial crisis. We have it currently, and think of it as a buffer. So rather than just stuffing everything in the drain, it says, look, hey, we know you can't digest all this right now, so we'll essentially give you a loan to get some of those bonds back temporarily so you can chew them through the system. Because primary dealers need to sell them. They can sell them to commercial banks, they can sell them to their clients, they can sell them to anyone they want. And so it's just meant to buffer all of that, all of the issuance into the system. Now, if there's a question about, well, gee, maybe all this debt issuance is a problem. No, not so much. And I'll tell you why. Because the bond market is effectively telling you there isn't a problem. So let's take a look at 10-year treasuries. Yields. Look, this chart right here represents 80% of the bond market. You're like, well, where's the other 20%? On the Fed's balance sheet, so it's irrelevant. The Fed you can't trade it. So 80% of the bond market since March has effectively agreeing that there's no growth in the economy, but there may not be any further contraction. They're just indifferent. They're just not sure. So 80% of the bond market on the 10, and you can look at 10s, 5s, 30s, is relatively convinced there's no growth. So the notion that there's a problem with the bond market digesting all of this at a rapid pace is not there. So there's a small amount of money in loans from the PD, primary dealer credit facility, PDCF. But it's a temporary thing, or just to grease all the stuff going down the garbage disposal. Maybe that's a good euphemism for all the government debt we issue, possibly. So that's where I'm going to leave that question off, and I'm going to let that person resubmit any part of it they want. And if that was your question, I'll forward you to the front of the line, because obviously that's only fair that I'm not going to read every bit of this. Now, there is another part that I do want to go through. It says there's also $700 billion in commercial industrial loans handed out by banks since February. I believe you mentioned that this is from corporations using their revolver credit lines. Could this possibly not be from the securities dealers taking out credit? No, it is. It's pretty much entirely due to this is corporate debt. So commercial industrial loans. This is not the securities dealer. So just, yeah, I know you're looking at the HA data. It's not that, just so we're on the same page on that. So if this is all true, you mentioned the banks are currently barely loaning out 1 times against their reserves, and this means that the Treasury, banks, and Fed collectively have a lot of leeway to create inflation, especially since you also mentioned that you believe security dealers are somehow forced to buy up all the security treasuries. No, they are. I mean, I actually did. They are required to go there and buy. They're absolutely required to do that. There's no question about it. Appreciate your time, Steven. Looking forward to your answers. Woof, woof. Another big dog here. So here's the deal. Look, the banks have a lot of leeway to lend stuff out. There's just not demand for it. And that's why interest rates remain low. Because if there's a lot of demand for credit, interest rates would rise. That's how it works. So again, if that was your question and you want to resubmit some parts of that, please do. Okay, the South Korean data should be out. Let's go take a look. And, month over month, it improved from minus 0.9 to 0. I mean, that's better than, if you're looking for some sort of recovery, that's not great, but hey, it gives you some sense of optimism. Not a lot, but producer prices, this is prices coming out of the factory, but here's the key, minus 1.7% the prior month, minus 1.7% year over year in May. Pretty much tells you prices coming out of the factory in South Korea are in a deflationary mode because they are contracting. So from that part, on a year over year basis, not that great. Okay, let's go back to some of your questions and see if we can pick through a couple of them. Hey, Steve, I've been seeing a lot of fast food chains, gas stations, and many other low-wage jobs looking for workers to hire, which made me wonder. I don't know. I know you don't like hypotheticals. Okay, let me address that. Look, macro is full of hypotheticals. I mean, it's hypothetical 101, I guess. I mean, we're always looking from macro perspective to try to figure out what's coming next. The place I don't want to play hypothetical is with the monetary framework. So the reason I don't, and the person who submitted the question, we're all cool. We're totally cool with each other. It was just, what I don't want is someone who's brand new to come on, watch the show, hear us talking about maybe moving some pieces around to the monetary framework, and then they, not knowing that we're playing make-believe that day, think that that's how the system works. So I'm cool playing hypothetical, okay? I just don't want to play hypothetical with a monetary framework. Now, what about, well, you took questions about MMT. Yeah, because that's just what's going on in the news, and people want to understand, is there actually MMT going on? And the answer is no. Well, what would it take to get it? Well, this is what you'd have to see. Now, is that hypothetical? No. If you start seeing Congress start to pull apart pieces of the Federal Reserve Act and talked about it, yeah, now we're headed down that path. So there are some things that are worth discussing because they're in the news, but I don't want to pull the monetary framework apart. It is the foundation of our house. Now, as we build the house and people want to move malls around and look at some things, yeah, I'm cool with that. So, but that's the nature of what macro is. You're always looking at what ifs, but there's certain things that you should not ever touch, and that is the things you know for a fact. So if we extend unemployment until after the elections or maybe some type of universal basic income to keep people happy, then wouldn't there be an early brief period of stagflation? Stagflation is rising interest rates and rising consumer prices rather than deflation. Well, here's the problem with that. You'd have to have demand. So what we see in the factory sector right now is monster amounts of slack. I mean, we have huge inventory levels. We have huge slack in the factory, so we'd have to have so much demand that we chewed through all that slack. I don't think so. And we'd have to see a lot of lending demand. If you're on UBI, let's just say you're on universal basic income or extended unemployment benefits, you still can't get a loan. That's a problem. I'm asked the boy, he works car dealership. I said, well, not for much longer, but he's going to go sell life insurance, so you can commiserate with him. I know I have a license, so I can pick on him. But you can commiserate with him in the comments if you do that for a living. The bottom line is, I asked him, and I knew the answer, can people get a loan if they're on unemployment benefits? He says, no, I could sell cars all day if that was the case. Right, what do you mean? You can't say you work for the state? No, it doesn't work that way. So no, odds are we would not see stagflation at all. The reality is you're seeing all of these jobs for hire on the low wage just because those people are at home making more money being unemployed, and a lot of employers are calling them but feel guilty recalling them and saying that, hey, I'm recalling this person, and they said no, so they're losing their unemployment benefits. A lot of employers are just not comfortable doing that. Again, I said this was a political mistake, paying people more money to be at home. I mean, I understand, making people whole. I'm fine with that. But now what we're finding is just the opposite, is people don't want to go back to work. And do I blame them? I don't at all. Deflation makes more sense with our current monetary policy, but please explain to me how putting money in the hands of people will not create stagflation. I think I'm missing the bigger picture. Again, they'd have to take that money and borrow. They can't. They effectively don't have jobs. And so they'd have to not only chew through all the inventory that we have piled up, pull the factory, get the factories running at full capacity, plus then you could see it. But based on the credit data and everything else, the government transfers aren't enough. And part of the question was, what if we get the extension of these through the election? I don't think that's going to happen. I don't think that's going to happen at all. Let's see. Let's grab a couple more questions. One more question. How about one more? So this question was, I'm going to fix it so it, actually it should not say bong prices. You did not see that, but that is really funny, actually. I was looking at TLT chart. Now, see, I'm going to fix this for how the question could be read. Bong prices, that's so great. Only on this show, right? So here's the deal. If you ask questions generically, I can answer them perhaps knowing what you're really asking. But if you ask what the security, I cannot answer them that way. So I'm going to rewrite this question and answer it generically. I was looking at Treasury bond prices, trying to figure out where bond prices can go. And I noticed that bond prices is on an uptrend since inception. Basically, if we ever get negative rates or perhaps stagflation, what do you think will happen to bond prices? Who's going to buy them? Okay, number one, bond prices. I am, guess, yep, you know it, super bullish. They're going way, way, way up. Now, next question is, who's going to buy them? Oh, that's easy. The Fed and all the people that are buying stocks that claim to never buy bonds. Remember, the public buys the most at the peak. They like to buy what's high and rising, particularly American investors. You watch, they'll buy bonds at the peak. I know you say that's not going to happen. It will. What's your expectation for fixed income alternative when rates go negative? I don't yet. I don't have. I have some ideas, but I don't know for sure what I'm going to do with that yet. Thanks. You're welcome. P.S. Hi, person from Chile. I'm from Argentina. And so we'll end the show with where bond prices are going. I'm your host, Steve Van Metre. I appreciate you watching and putting up with my inability and lack of desire to push the edit button. I'll see you in the comments. I'm sure it'll be interesting. The content of this video is provides educational information only, is not intended to provide investment or other advice. This trail is not to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity and business express. The video that do not reflect the view of Alice Financial Advising or Steven Van Metre Financial.